exchange. We'll touch on a couple of more complex structures. I already had a question about improvements, so we'll touch on that a little bit, and we'll touch on reverse exchange strategy a little bit, but we're going to keep it fairly minimal. Of course, your questions are most welcome, and I'll answer as many of those as I can. If at the end of the presentation you still have questions that you don't feel were answered, feel free to reach out to me directly. We consult free of charge, me or my team. We've got 4 people here in the Bend office, and any of us should be able to assist you. So just a little bit more about me. As Kevin said, I've got over 25 years experience in the industry. I was an escrow officer at one time. I worked in mortgage lending and worked for a regional home builder in the building and development industry a bit as well on kind of the lending side of that. And I do have over 13 years specific industry experience with 1031 exchanges. I kind of am the person in the office that runs most of the more complex exchanges, although we do the whole gamut. Kevin asked at the beginning, is there really such thing as an easy 1031 exchange? And my answer is absolutely there is. But we are seeing less and less of them in this crazy market. I also have our industry certified exchange specialist designation, CES. And that simply means that I have over 3 years industry experience, have passed a rigorous exam, and just like you folks have to maintain a certain amount of continuing ed and with emphasis on ethics and industry standards. So again, 1031 Corp is the name of our company. We are right here in Bend. Many people, especially folks in the area that have been in the industry for a long time, may still think of us as 1031 Asset Exchange because that company was around for a long time and was run by Sana Finney, who I'm sure many of you know. Sana and I had worked together in the past doing 1031 exchanges, and when she decided to get ready to retire, she called me up and invited me to come back and rejoin the industry. So I came on with 1031 Corp in January of 2016. So this will be my 5-year anniversary with 1031 Corp. And again, we're a local company. As Kevin stated, I think folks, particularly in Central Oregon, like to work local, and especially during the pandemic. It's been a little bit different for us because, as you can see, I'm working from my house. I've been doing that since March. And it's been a little disappointing not to be able to meet with clients in the office as we typically do. I mean, I think that that's one thing that gives us a leg up in the industry, is that for folks that are here locally, they can just pop into the office and see who they're working with. And there's a lot of value in that. We can facilitate exchanges in all 50 states, even though we're right here in Bend. 1031 is a federal tax code, so you can exchange properties in and out of any of the 50 states. There are a couple of states that do have licensure requirements, and we are compliant with those. So we can work anywhere. Our corporate office is just outside of Philadelphia, Pennsylvania. So we have ties to the East Coast as well, and a lot of great resources in those cases where we may be working in jurisdictions that we're not quite as comfortable with. But by this point, I kind of feel like we've done exchanges everywhere. So really the point today, kind of the objectives today of what we're going to talk about, is just really a basic understanding of what is a 1031 exchange and why do people do them beyond just the tax savings. I want to give you a little better understanding of what qualifies as like-kind property, and how you can maximize the tax deferral, or your clients can maximize their tax deferral for buying power. Really important thing to talk about, I think, especially for real estate agents that are helping their clients try to locate replacement property, are the timeframes involved with the 1031 exchange. And then again, just touch on some of the more complex strategies. So we'll start with, what is a 1031 exchange? Well, it's a section of the IRS's tax code that provides that no gain or loss is recognized on the exchange of a property that's held for productive use in a trade or business or for investment. So the key is, property that's held for investment or business use purposes, excuse me, not personal property, personally held property. And prior to 2018, business assets could also be exchanged, or not inventory, but equipment and the like, but that is no longer the case. So it is restricted now to just property that's considered real estate. So obviously the most immediate benefit, why do you do a 1031 exchange? Because I don't want to pay my taxes. I want to avoid the taxes. But there are other reasons that may make sense to do a 1031 exchange other than just that, or just benefits that you get from the exchange. You can relocate your assets. Perhaps if someone is making a move to a different state and they don't want their assets to be, so far away from them, or to diversify the type of assets they hold. You could sell a multi-family apartment complex and buy several single family units, or vice versa. Maybe people just want to get into something that has a little less management, and so they may look into more of a triple net type of thing. Again, have a coupon type cutter investment. I mean, there's just a lot of different things that you can do. Growing your assets is a big one, is taking the equity that you have in one property and using that to leverage multiple properties to kind of grow your portfolio. So there's a lot of different benefits to it.
Danielle,
and yes,
before you move on, we already have a couple questions in the audience. Okay. And you may be getting to some of this as you go. So if you are, we might want to hold off on answering it. Mm-hmm. But the first question is if a 1031 buyer identifies a property but would like to do a bit of renovating or updating, can those dollars be considered as part of the sum of the exchange?
We will get to that, because it's kind of a complicated answer. So we will get to that toward the end of the presentation when we talk about the more complex strategies.
And the other question was, can you exchange lots or land?
Yes.
And you'll probably touch on that too.
Yes, you can. Yep. Yeah. And I will go over kind of what is considered like kind. And then I want to dispel some misconceptions as well, things that we hear a lot when people call up. You don't hear this as much anymore, but there are still some folks that think to do a 1031 exchange, you have to do a direct swap of property. I take yours, you take mine, and that's an exchange. While that is possible, and we do see that sometimes, particularly in agricultural areas, it is not necessary. They're called delayed exchanges because you can sell and then you have a period of time, 180 days, to acquire your new property, and it does not have to be from the same party. A big one is that many times folks think that when you do a 1031 exchange, you only need to replace your gain or replace your equity, and that is not the case, and we're going to go over that in further detail as well. Like kind does not mean like use. It does not mean like zoning. We're going to go through that. It's not an all or nothing strategy. You can take some cash out and pay tax on some of it and reinvest the rest and still have a tax benefit there. And again, the idea of them being complex, they don't have to be. Some of them get very complex, but your standard delayed exchange really is not that complicated. It's just another step in the process. And the idea of expense. Our fee structure is pretty minimal compared to the tax savings, unless you get into those more complex transactions. The majority of the exchanges that we do, we charge $995 for. Just a simple, straightforward, I'm selling one property, buying one property. So, so we'll talk about this in a little more detail. Like kind. Again, with real estate, we're contained to just real estate now, but it refers to the nature and character of the property, not to the specific use of the property, meaning again, it's property that's been held for productive use in a business or as an investment. And so it's a very broad definition. You can buy any of the 50 states. Again, you can buy and sell multiple properties. And here are some examples of what are like kind. So a duplex, apartment building, rentals, office buildings, bare land that's been held for investment, farmland, We'll talk a little bit more about mixed use properties, but you can, sell a farm and allocate the residents outside of the exchange, and the seller can take the proceeds from their residential portion and exchange the land that's been held as a productive farm land. And you can mix and match all of this. Another thing that we see a little less frequently, but it does come up, are leasehold interests. And so if a good example of that would be for a hangar at the Bend Airport, for example. You don't own the land underneath it, but you have a long-term lease on that land. And as long as the lease has a life of at least 30 years remaining, including options, that is considered like kind to real estate. And then these would be examples of things that aren't like kind. Personal residences don't qualify. Most vacation homes, particularly if you're not ever renting that vacation home out to others, don't qualify. Partnership interest, that's something that comes up a lot. We'll talk a little more in detail about it when we talk about same taxpayer. But oftentimes we will get phone calls from folks who say, hey, my partner and I are selling a piece of property. We want to do an exchange, but we don't want to buy together. We're in an LLC or a partnership and we don't want to buy together. We want to go our separate ways. Well, technically the partners in that partnership do not own the real estate. The partnership owns the real estate, and what the partners own are shares in a partnership. And shares in a partnership are not exchangeable. So that is something that involves a little more advanced planning to try to get that separated out well ahead of listing and selling the property so that the partners are able to go their separate ways. Mortgages and notes are not exchangeable. If you sold a piece of property on a seller financing note 10 years ago and you're about to get paid off, it's too late to do an exchange. Note proceeds aren't exchangeable. Cash is not exchangeable. Non-real estate assets, again, equipment, inventory, things like that. Dealer property and inventory. If you have someone who buys a piece of property and partitions it out into 20 lots, you can't exchange those. That is inventory, not property that was held for investment use per the IRS's definition. And then stocks, can't exchange those through 1031. Qualifying use, the holding period as far as what constitutes a long-term investment is not actually defined in the 1031 tax code itself. But in other areas of the tax code, 1 year is kind of considered long-term. For example, when you have owned a piece of property, investment property, for at least 1 year, it now qualifies for long-term capital gain tax treatment. So a year is a good rule of thumb. 2 years is even better. And sometimes circumstances change. Intent is very key when the IRS is looking at whether or not you've held a property long enough to exchange it, or whether you're purchasing a property that you intend to hold long enough for it to qualify as an exchange. And sometimes, especially right now in this crazy world, intent changes. And so it's really important that you can paint a good picture that, well, I only bought this property, 9 months ago or a year ago. However, perhaps there was an unsolicited offer for well over what you paid, and it would seem silly to forego that offer. Or maybe the rental isn't working out the way you thought, and you're not able to rent it out, and so perhaps you decide to exchange and buy an asset that may be more lucrative. So those are important factors, and the personal use of the property is a very important factor as well. In the case of vacation homes, for example, your use, the exchange or the owner's use of the property, is limited to 14 days a year, or 10% of the total days that they have that property rented out to others, whichever is greater. So for example, if you have a property that's an Airbnb and you are renting it out 200 nights a year, you could use it 20 nights a year. But it's limited to that 14 days or 10%, whichever is greater. And I think it's important to note that when the IRS is looking at personal use, if you're allowing family members to use it free of charge, your kids go stay or your parents go stay, that goes against your personal use restrictions as well. So important to note. So we'll talk a little bit about the role of a qualified intermediary. That's what we do. 1031 Corp is a qualified intermediary. You also will hear us referred to as accommodator or facilitator, and those are all interchangeable terms, but QI is actually what's in the tax code. And the role that we play is kind of acting as the middleman to facilitate an exchange. Back prior to 1991, when an exchange was done, the deed actually transferred to the intermediary, and then the intermediary deeded it to the other party, the buyer in the case of the relinquished property, or the seller in the case of the replacement property, and we no longer do that. The deed flows directly from the buyer to the seller like any normal transaction, but we do have documentation in place that makes us a party to the escrow, and we hold and convey both properties, but not via the deed. We prepare all the necessary documentation for the exchange. It's very important when you do a 1031 exchange that your exchange agreement is signed prior to closing, that you have all of that set up and in place before closing, and that those proceeds are never in the control of the exchanger. So when escrow closes, the money's wired directly to our account that we have set up for the exchanger. We have segregated accounts. Nobody's money is ever pooled together. So each individual exchanger has a segregated account. That money comes in and is wired directly to the account. The exchanger can't have control of those funds during the exchange. So once we're holding funds, if somebody calls and says, oh, hey, I know I'm going to have some money left over, or I have some things that came up, I need to take some money out of the exchange. Unfortunately, we can't do that. There are strict restrictions on when we can release money from the exchange. We can only release proceeds to purchase property that was properly identified within the exchange period. And if there's money left over, those funds can't be released until the end of the exchange. We coordinate closely with the escrow agents and real estate agents on the details and the timing. And we're just kind of an added party to the transaction. And then, of course, very important, keeping the exchanger aware of the rules and regulations and aware of their deadlines and timelines to make sure that they don't miss out on the opportunity to complete their exchange successfully. A qualified intermediary has to be kind of a third party that has not acted as an agent for the exchange, for the exchanger, and they can't be a close relative, employee, partners, anything like that. Anybody that's provided legal or real estate services or acted as an agent within the last 2 years cannot be considered an intermediary. So you can't just give your money to your sister and let her hold it and have that still qualify. I think this is just kind of the parties and their roles within the exchange. You know, the exchanger is the taxpayer that we're working with that's deferring their gain. They're going to sell their property to a buyer on their relinquished property. They're going to purchase their replacement property from a seller. Generally, again, we're working closely with the real estate professionals, tax advisors, accountants, CPAs are critical to the process in many cases. Unfortunately, a lot of people do taxes on TurboTax and things like that. They may not have tax advisors, but generally what I'll tell folks is, well, if you don't have an accountant, this is probably the year to get one. And you probably don't want to tackle this one on your own. So it's always great to have tax advisors as well. And then occasionally in some cases, particularly with larger commercial deals, things like that, we're dealing with attorneys as well. And then, of course, our role as the intermediary. We provide a 1031 exchange agreement, which really just places restrictions on the funds, puts us in the role of the intermediary. And again, it has to be signed prior to the transfer of the relinquished property. Occasionally, we will get phone calls from folks that say, I just closed yesterday. I have a check, but I haven't cashed it. Can I still do an exchange? It's too late. Too late to do an exchange. If you have that check in your hand, or if you did not have an exchange agreement signed prior to closing, you have had control of those funds. Even if you haven't exercised that control or done anything with them, you've had control of them, it's too late. So it's very important to get it set up ahead of time. And right now with the market such as it is, the sooner we can get involved, the better. I know that's not always possible because things are happening so quickly right now. I've seen a lot of transactions that we've set up for exchangers that they've had multiple deals fall through, two or three sales fall through, and everyone is kind of this rush and it's closing in a week and then all of a sudden it falls out. So I understand for some people the hesitance to get it set up well ahead of time, but it really helps us to be able to communicate clearly all of the expectations and make sure that we're really interviewing the client and that this is the best course for them and that what they're trying to do qualifies. If we're working on a real last minute situation, sometimes it just doesn't give everybody time to understand the full picture. So I would encourage you, if you have clients that are looking at doing an exchange, to at least have them reach out and do a little consultation with us before they make their final decision. That's fine. We consult free of charge. So never hesitate to reach out and shoot questions our way, either on behalf of your client or send your client to us to answer any questions that they have so they can make that decision. We provide an assignment of the agreement of sale. So essentially that is the exchanger assigning 1031 Corp as a party to the transaction so that we can facilitate the 1031 exchange. The other party must be notified of that. That is normally done in the purchase and sale agreement, but we always have the other party acknowledge our assignment as well so that we have documentation that they have been made aware of the 1031 exchange. And then I think this is real critical, again, especially I think for real estate professionals, when you are helping your clients to find replacement property, that you have a good understanding of the time periods involved and the rules of identifying property. So your exchange time periods begin as of the date of closing on the sale transaction. So generally here in our area, that's going to, the closing date is usually the date it records and funds are distributed. In some places, those dates may differ a little bit, but it's really the date that the buyer took on the benefits and burdens of ownership of the property. So usually that's the date the deed recorded. From that date, the exchanger has up to 45 days to identify in writing potential properties that they would like to exchange into, and 180 days from that closing date in which to complete the exchange and acquire any replacement properties that they're going to acquire through the exchange. You've got this time of year is a little different because you have 180 days or the date that your tax return is due. So if one were to close on a sale today, they would have to file an extension on their 2020 tax return to take them out past April 15th in order to get the full benefit of that 180 days if they needed that much time. And we put that in all of our documentation. We put that in our identification paperwork just to remind people of that fact. You can't file your 2020 return until your 2020 exchange is complete. So if you have not acquired that property by April 15th, an extension would be necessary. And the identification rules can get a little bit complicated. If an exchanger intends to just purchase one property that is going to complete their exchange, generally they're going to be limited to identifying 3 properties. So you can identify up to 3 properties of any value. You can identify, the one you think you're going to buy. Maybe you have it under contract, put a couple of backups down, because you don't have to buy everything you've identified, but you can't buy things that weren't identified. So up to 3 properties can be identified. If you identify more than 3 properties, then there's this 200% rule, which says the total aggregate value of all the properties that have been identified cannot exceed 200% of the fair market value of the property that was sold. So if I sell for $1 million, I can identify any number of properties up to $2 million and pick and choose which of those I want to buy. Usually when we see this is when someone is selling a larger, maybe a multifamily type property or a commercial property, and they want to buy several smaller properties. They're going to kind of fall into that. But if I sell a property for $1 million and I know I want to buy another property that's at least 1 million, I'm going to be limited to only identifying 3 properties. The third exception to that 200% rule, which we really try to steer people clear of, is that if you identify more than 3 properties, and if the total value of all of those properties exceeds 200% of what you sold, you are required to purchase to acquire 95% or more of everything that you identified. In most cases, that generally means you have to purchase everything. And we did have a case, it was shortly before I came on, that we had a client who was purchasing several newly constructed homes, was sure he was going to be able to close on everything. The builder was not able to get one of the houses done in time, and his entire exchange failed as a result. So again, we really try to steer people clear of that 95% rule and keep you identifying under 200% so that we don't have to go into that. And again, I know that these can be confusing, so any questions you have or need that reiterated, let me know.
We do have one question with regards to identification, and Melissa in the audience is asking, how do you go about identifying to the facilitator? For example, does it have to be in writing? Does an email work, or is there a specific form?
Well, the IRS's qualifications for identification is that it be delivered in writing, signed and dated prior to midnight on the 45th day, and delivered to the intermediary. We provide a form for that. It's not a form that is generated by the IRS, it's our form, but we do provide a form for that. Again, it does have to be in writing. The properties have to be unambiguously identified. So you would not be able to say, oh, I'm going to purchase a lot in the Bridges subdivision. It has to be specifically unambiguous, either by address, legal description. In some cases with agricultural type properties, I may encourage folks to attach even a map with an outline of the property they're identifying, so there's no question. I have had exchangers in the past transpose numbers in addresses. So I always encourage as much information as we can get, as many different identifiers for the property as we can get, so that if there is maybe a transposition in the address, you can go to the legal description and say, no, this is the property, it matches up. Emails, I would expect at some point there may be some challenge about whether emails can be accepted or not. Generally, no, we do not accept emails. We always attach, if there's any discussion, we'll attach those to the identification so we have record of any discussions that we've had, but we do require that they be submitted either scanned in and faxed or emailed to us, signed and dated, and then we acknowledge that we've received it in a timely manner. And once that 45-day period is over, no changes can be made to that identification form. So once the 45-day period is over, if you do an inspection and decide that you don't want to purchase a piece of property, or maybe somebody else comes in and outbids you on a property, unfortunately, if none of those properties are available any longer, you have a failed exchange.
Also, we have a question that says, can you sell a commercial restaurant building and exchange that into an apartment complex or multi-rental houses?
Yes. Yes, if you're selling a business like a restaurant, for example, I actually have a restaurant exchange going right now. You just want to make sure to allocate, generally you're going to have a value on equipment. You may have a value associated with Goodwill or Blue Sky, the business name, the customer list in some cases, things like that. Those things cannot be exchanged. So we would want to allocate the value of the equipment and the business itself, and that would just be paid out to the exchanger directly, and the exchange would involve just the value of the real estate and the improvements to the real estate. But yes, you could sell a restaurant property and purchase an apartment building. No other questions on the identification? Okay. So this is just kind of the flow of an exchange. Again, dispelling the myth that it somehow complicates matters. You'll see that this is not much different than any other real estate transaction. You're going to sign a listing agreement with your client, and eventually when they get an offer, these days, 2 or 3 days from now, when they get an offer, or when they get 8 offers, they'll accept an offer and sign the contract of sale with their buyer. And at that point is when we would step in, get a phone call from the client saying, okay, I'm under contract, I'm closing January 15th, we want to retain your services. And so I would then get a copy of the purchase and sale agreement, a copy of the preliminary title report for review, and just make sure that if there were any partnerships or LLCs involved, that I was getting operating agreements for that, just review everything, gather all the information, and prepare my exchange documents. I also then prepare closing instructions to the escrow agent, just instructing them the language that we like to see in the closing documents, providing them with our wiring instructions, so that we're all set to go. When the closing takes place, the funds are deposited with us, again, generally via wire transfer. We do hold all of our exchanger funds in interest-bearing accounts. Of course, right now, interest is very minimal, but we do hold those in interest-bearing accounts for the client. The client gets the benefit of that interest. And that's when the 45-day and 180-day period begins, as of that date of closing. Sometime within the 45-day time period, they're going to identify to us the property they intend to buy. And just like on the other end, I would want a copy of the contract on that, that new property, copy of the preliminary title report. And then at closing, I provide the funds that we have on deposit. If the client needs to add funds to the transaction, they wire those directly to escrow. They go in and sign their closing documents just like any other transaction. I approve all of the documents as well. And then the property closes and the exchange is complete. So that would be a very simple exchange. I do want to make one note though about identification and earnest money deposits, because I think that this is valuable for agents to know. So once we have funds on deposit and your client is in that 45-day identification window, they do not need to notify me before they can make an offer on a property. So you can go out, you can write offers. If it's not accepted, you move on to the next one. If it is accepted, then you'd want to let me know. The client can write a check for the earnest money out of their own pocket if they want to do that. If they know they're going to be adding funds to the transaction anyway, that probably makes sense. But once I have funds on deposit, I can also write the earnest money out of the exchange account. In those cases, I just suggest, you make the earnest money note redeemable in 3 to 5 days or something. That gives us time for me to get the contract, review it, have a couple of documents that the exchanger signs to allow us to write that earnest money check, and then we can just wire the earnest money or write an earnest money check for the replacement property. So just want to make that clear. Also, if you have a client that's under contract on a sale and they happen to find something and they want to write an offer before their sale is closed, that's okay too. So just know that. So we'll talk a little bit about the tax consequences. In order to have full tax deferral through a 1031 exchange, you have to acquire property that is equal or greater in value and equal or greater in equity. So when we look at what is equal or greater in value, that's going to be your gross sales price less the closing costs that are a direct result of the sale. So that would be your real estate commissions, your title and escrow fees, if the seller's paying any money toward the buyer's closing costs, if there's any required repairs that need done that are required per the contract, those are all considered costs of closing. So those reduce that gross sales price down to the value of the property. What is not taken into account when we're calculating how much they need to replace is any debt. So if I'm selling a piece of property, we're going to take out the closing costs for ease of the illustration here. If I'm selling for $200,000 and I have $100,000 of debt that's going to get paid at closing, I'm going to have $100,000 in equity, cash equity, but I still have to buy $200,000 worth of property. So you have to buy equal or greater in value and reinvest all of your cash to have full tax deferral. If you do trade down in value or have any cash left over, that portion is taxed up to the total amount of the gain. So if someone is trading down in value, particularly if it's a larger amount, I always suggest that they consult with their tax advisor and make sure that they really understand how much gain they have in the property, and that if you're trading down, are you still saving enough by doing the exchange to make it worth doing the exchange? So it is a conversation to have, but it isn't an all or nothing deal. You can have some tax benefit and some tax burden. And what happens when you do an exchange then, the basis in the old property, your adjusted tax basis, carries forward into the new property. So that's how your gain kind of follows you. And that's why it's considered a tax deferred exchange and not a tax-free exchange. Because if you do an exchange and don't pay taxes on your gain, that's going to follow you into the new property. And then if there's any increase in value in that new property, that increases the basis up by that value. Depreciation follows it as well. So you would have that old depreciation schedule that would come forward, and then any added value on the new property, you could start a new depreciation schedule. Or you can opt out and just depreciate at the lower basis. There's a couple of ways to handle that. And I always like to do this when I'm doing a live class. So I want to make sure everybody understands how basis and gain are calculated. If anyone wants me to go over that really quickly, I'm happy to. Just maybe raise your hand or pop a question up there, and I can do a real quick overview of how you calculate basis and how you calculate gain. Anyone? Okay.
I'd just give them a quick second to type. So
okay.
Yeah.
Oh,
we do have.
Oh, you're muted, Kevin.
Yes, we do have a couple that are saying sure they'd like to know that.
Okay, so your your initial basis in a piece of property is essentially what you paid for it, as long as you did not exchange out of something else. So if I go out and buy a house for $250,000, my basis in that place is $250,000. If I make $50,000 worth of improvements to that property, capitalized improvements, then my investment, if you will, in that property, my original $250,000, I can then add that $50,000 onto it. And now my basis is $300,000. And on investment properties, you are allowed to take depreciation. So you depreciate the asset over, I think it's 27 years. So every year the IRS allows you to take depreciation, and that depreciation reduces your basis. So again, if I buy for $250,000 and I add $50,000 of capital improvements, but over the years I've taken $25,000 in depreciation, my basis in that property is now $275,000. And then if I sell that property for $400,000, the difference between the $400,000 and my $275,000 in basis is my gain. And that is what your capital gains tax is calculated on. So that's kind of the first step when someone's selling something, is to work those numbers through with their tax person and say, how much gain do I have? Do I really need to do a 1031 exchange? Well, yeah, if you have, $125,000 worth of gain, that's no small portion. You might want to look at doing an exchange. So that's kind of the first stage. But then again, to have full tax deferral, when I go to buy my new property, that means I have to buy that higher value. I have to buy equal or greater to what I sold it for and reinvest all of the cash. And then that deferred tax goes into the new property. So hopefully that helps a little bit. State income taxes, of course, vary from state to state. Some states, Washington State, I do a lot of business in Washington, they don't have a state tax. And so when folks are exchanging out of Washington property, they're just deferring their federal income tax. But most states do follow the federal guidelines. And if you defer your federal tax through 1031 exchange, you also are deferring your state income tax. And the taxes are tiered, both federal and state taxes are tiered based on your income. And so when people call me up and say, oh, how much would my tax be? I can't really answer that question because I don't know what your full tax picture looks like. Again, with the exchange proceeds, we've already talked about this. The funds are held by the qualified intermediary. You can't control the funds. I'm in control of those. You earn interest, and we do have a couple of different accounts that have various levels of security. We offer what we call qualified escrow accounts. If people are interested in that, we offer that at no additional charge. And really what that does is it just kind of gives the exchanger an extra added level of security from us, frankly, that we will not be able to spend their exchange proceeds without them knowing that. The bank actually acts like an escrow agent, and the bank requires client signature and our signature before they move any money. So again, that's something we offer free of charge, and I recommend it, especially for folks that have, you know, higher dollar amounts on deposit. This is an important thing to talk about, the same taxpayer requirement. When you do a 1031 exchange, the same taxpayer that sold the relinquished property has to purchase the replacement property. This doesn't necessarily mean that the names have to read exactly the same. As far as the IRS is concerned, we're all just whatever our tax ID number is. And so however that property has been reported, under whomever's tax ID number that property has been reported, that's who has to complete the exchange. Usually what we'll see, this come up a lot, again, with partnerships, LLCs, you can't have an LLC or a partnership sell a property and then the two individual partners buy a property. They are not the same taxpayer as the taxpayer that held the property. One thing that does come up a lot of people will hold property in trust, in revocable living trusts, or in single member LLCs. And those are both considered disregarded entities for tax purposes, meaning that those entities don't have to file a separate tax return. So if I have an LLC of which I am the only member, that LLC is not a separate tax-paying entity from me. The assets of that LLC are reported on my tax return. So I can sell in a single member LLC and buy in my individual name, or I can sell in a trust and buy in my individual name. But again, it follows that taxpayer is the key. And just briefly touching on the primary residence exclusion, I think it's always good to make sure that people understand, I'm sure all of you folks do because you're in this industry, that section 121 of the tax code provides an exclusion for folks that are selling their primary residence that they have lived in for at least 24 months out of the last 60 months. And those folks can take up to a $250,000 gain as a single person or a single tax filer, or $500,000 as married jointly filing taxpayers and pay no tax on that at all. And you can only do that once every 2 years. I have had situations where I've talked to exchangers and they call and say, oh, I'm selling a rental. I used to live in it, but I've been renting it out for the last year or two. And they may still qualify for this because that 2 years the 2 years that they've resided in the property doesn't have to be the last 2 years. It just has to be a total of 24 months out of the last 60 months. So it is possible that someone could move out, rent a property for a time, and still be able to take that residence exclusion, which is obviously a much better deal than doing a 1031 exchange because you're not just deferring your taxes, you're getting rid of them altogether. I'm trying to speed up a little bit because I think we're running out of time. Vacation homes, we already touched on this one with the personal use being limited to 14 days or 10%. When you are selling vacation homes, you must have at least rented it out for 14 days in the 2 years prior to selling it in order for it to qualify. So if you've rented it out for 14 days and it's set vacant the rest of the time, that could still qualify for an exchange. If you haven't rented it out at all and you've used it, solely for your own purposes, that gets a little bit stickier. So always good to have that conversation. Mixed use property, I think I already touched on this, where you allocate a value to, again, a farm is a good example. You allocate a value to the primary residence. The exchanger can take that section 121 exclusion on the residence portion and 1031 the business portion. Occasionally, we will also see this with like a duplex that maybe exchanger lives in half of the duplex. Same thing, you can kind of allocate and exchange part of it, not exchange the other part of it. And this section, I think we will skip over because we're running out of time. And I wanted to touch on the reverse and improvements real quick. It's really just calculations of kind of how 1031 helps avoid tax and how much more leverage it gives folks when they're buying. And anyone who's interested in getting copies of these slides after the fact, contact me or contact the Deschutes County Title team, and we'll make sure that you get copies of all of the slides. Reverse exchanges particularly I wanted to touch on because we are seeing a lot of inquiries about this right now. With the market the way it is, people are just not sure that they're going to be able to find what it is that they're looking for within 45 days of their sale. And so with the reverse exchange, there is a structure wherein an exchanger can go out and identify the property that they want to purchase, and we step in along with them. They and or their bank loan the money to an entity that we create that's wholly owned by our company, and we acquire that property on their behalf. And then we lease it back to them. We give them a promissory note. We hold title to the property. And from the day that we take title to that property that they desire to purchase, they then have 180 days to sell whatever they want to exchange out of and acquire that property back from us. So it can be a bit of a complex structure. If anybody's interested in learning more about that, I can certainly provide more information. When I will say this, that when there is loan financing involved, that becomes a lot more complicated. It's much easier with a reverse exchange if the client has the ability to pay cash for the property. Any kind of conforming type loan, like a Freddie Mac, Fannie Mae product will not work with us on those reverse exchanges. And so either a bank that holds their own portfolio or client funds are really make that a much better prospect.
Danielle,
Yep.
We have a question saying, do you think 1031s will be eliminated or changed, the rules changed under this new presidential administration? He's getting a lot of questions and concerns from clients.
Yep. We are getting a lot of questions and concerns from clients as well. A lot of questions. And the truth is, we just don't know. I mean, it is possible. The Joe Biden's tax proposal did include some language that suggested that they may look at making some substantial changes to 1031. Whether that be elimination, I don't think so, or whether it be maybe a cap, on the amount of gain someone could defer taxes on. We don't see it as a huge threat. Our lobbying group and our professional organization has worked very, very hard over the years on educating our representatives all across the country. I've been myself, I've gone up on Capitol Hill a couple of times and met with representatives and senators and had conversations about the value of 1031. We've commissioned a couple of important studies that show the value of 1031 on the economy in general. I've talked to many clients. I mean, this is really kind of the point we try to get across is if you eliminate 1031 exchange, people aren't going to just simply sell their property and pay their tax. People just won't sell their property is what will happen. And that's going to slow the economy down. And that's really the point that we're trying to get across is this really is the purpose of 1031 is a real economic motivator. It's to get people to reinvest their money instead of taking their money out of the economy. I think obviously what's going to happen in Georgia in the next couple of weeks makes a difference on how worried we are. If everything is controlled by one party, it makes it a lot easier, obviously, to pass things. But I just think there's probably bigger fish to fry at this point. But again, we don't have a crystal ball. I sure hope nothing happens to it. This is my livelihood and it's what I love to do. But we will keep everybody posted. Anybody who is already on our mailing list will get newsletter blasts from us. And any kind of thing that we hear, we have our ear to the ground, we will update. If you're not on our mailing list and you want to be, I will be getting a list of the participants from Kevin after this is over, and I'll make sure to get you added to our mailing list so that you'll get any blast that we send out in regard to that.
So one more question came in, that is, they just want to be clear on exchanges. Taxes are only deferred, but at some point they will have to be paid, correct?
In most cases, however, if you hold a property until death, there is a step up in basis. So at the time of your death. And so again, going back to that basis calculation, if I own a piece of property I've owned for years and years and years, and I pass away, my kids inherit it, and the basis of the property gets stepped up to the value at the time of my death. So if they turn around and sell that property, you know, in the next few months for what it's worth today, there's going to be no gain. Now, there may be other estate taxes and things like that, but in that case, the capital gains do go away with that step up in basis. Occasionally, people will convert investment properties at some point in the future. Maybe they've held a rental for many years and they decide to retire and downsize and move into their rental. In that case, there could be some tax savings that, you know, when they eventually sell that property, some of it would be deferred under their Section 121. They may still have some taxes that were a result of any gain that was deferred and when it was still an investment property, but you can kind of bifurcate that and have some tax savings and not have the entire hit, if that makes sense. Do I see other questions popping up there?
Yeah, there's one more question Diane wanted to ask. Do you communicate with the real estate agent when your docs go to escrow? Her last exchanger was not good at that.
Well, I will admit, it depends on how communicative or how much communication I've had with the agent. If I have an agent that I know has been involved, they have been the one that's been giving me information, I absolutely make sure that they're copied on everything. It kind of goes both ways. Occasionally we'll have agents that just don't offer any communication or kind of avail themselves to that. But yes, if I have an agent that I know has been involved, I will copy them on everything so that they're apprised of the steps all along the way. I think, oh, go ahead.
Oh, there aren't any more questions at the moment.
Okay. Well, I think we're kind of out of time. I mean, I'll leave it up to you, Kevin. Do you want me to take a couple more minutes and briefly touch on this improvement exchange, or?
You've got 3 more minutes to the hour. So if
okay.
there's a couple high points you want to touch on, I'd go for it. And then we can just,
okay.
If you're open, if people still have questions, people that don't can go ahead and log off. Sure. But if they want to stay on, they can continue.
Okay. Well, we'll touch on this really quickly because a couple of questions did pop up. And kind of like the structure with the reverse exchange, there is a way to use a portion of your proceeds to make improvements. Building from the ground up is nearly impossible to get that done within 180 days. So we just don't see that much. But if someone's buying a property and they know they're going to need to put a $20,000 roof on it and they've got some money left over, then it is possible to structure the exchange in such a way that we can utilize those proceeds. I always encourage people, if it's minor repairs, well, let's backtrack a little bit. So the IRS has made it clear to us that you cannot use exchange proceeds to make property that you already own. So the moment they take title to that property, now they own it, now we can't use proceeds to make improvements. So if it's fairly minor repairs, you can work with the seller, bump up the price and have those repairs done prior to closing. That's really the best way to handle, you know, smaller stuff. When it comes to larger repairs or maybe reconstruction projects, things like that, we utilize that same LLC structure that we do with a reverse. And instead of the exchanger taking title to the property, I set up an LLC and our LLC takes title to the property for the period of time that the improvements are being made. And then once all of the exchange proceeds have been exhausted and the improvements are done, and within that original 180-day time period, we then transfer the property to the exchanger to complete their exchange. So there is a way to make that happen. So again, more of a complex exchange, if it's something that someone wants to talk about in greater detail, give us a call and we can chat about that. And that's really kind of all I have. So any other questions? You know, I can stay on for a bit and answer other questions if need be.
Yeah, so we'll just open it up quickly for questions. We have one question for clarification. Replacement property inherits relinquished properties depreciation schedule. 27.5, for example, 27.5 years less 20 years ownership of relinquished property equals 7.5 years of depreciation at the relinquished property's amount, plus added basis value of replacement property over 27.5 years.
Yep.
Yep.
Yep. That sounds right.
Getting some thank yous to you. Any
Well,
other
thank
questions?
you to everyone that logged on. Thank you for attending. And thank you, Deschutes County Title, for having me.
Thank you. Looks like we